The Federal Reserve is aiming for 2% inflation to ensure price stability and long-term economic prosperity. In August, the Consumer Price Index grew at an annual rate of 2.5%. Inflation, that's slightly above the target, but down from 2.9% in July and below economists' expectations. Since this time last year, gasoline prices have fallen by nearly 12%. The Energy Information Administration says the average price of a regular gallon of gas in August was $3.39. AAA reports the current price is even lower at $3.25. Short-term inflation, the change in prices over a month, was up 0.2% last month, in part due to high food and housing costs, a sign that the Fed might interpret as evidence of lingering inflationary pressures, which might make an expected rate cut smaller than expected. For more on this, I want to bring in Martin Baccardax. He is a senior editor and chief markets correspondent for the financial news site The Street. Martin, it's good to be with you again. The Federal Reserve is prepared, according to its chair, to begin cutting interest rates next week as the U.S. approaches this 2% goal. How do you think they read these numbers?
It's interesting, isn't it, John? Because we're seeing some stickiness in the various measurements that the Fed tries to use to sort of read the path of price pressures going into the autumn and beyond. You talk about that headline rate of 2.5%. It is getting close to the Fed's target, but when we start to strip away some of the more volatile components and we look at core underlying prices, they're still stubbornly high. We're seeing them in shelter. We're seeing them in things like insurance and daycare and all sorts of other expenses that can't really be avoided. So I think to some degree, the Fed is going to be a little bit frustrated by that. And as a result, they're probably likely to take their path of interest rate cuts a lot more patiently. Now, that might test the patience of Wall Street because they've been looking for movement from the Fed for a number of months now. They will get it next week in Washington. They just won't get as much, and they may have to wait longer for the ultimate destination.
So help people understand that. The market is looking at these numbers and saying, the Fed, seeing this stickiness in inflation, might just tweak rates down 0.25% rather than 50%. Is that the thinking? And if that's the thinking, what does the market then think will happen to economic activity?
Well, that's precisely right, John. I think at the moment, you have sort of a split discussion. You have those who would like to see the Fed move faster, maybe even cut interest rates by about 0.5 percentage point in order to get in front of what people think will be economic weakness going forward. There are other people who say if the Fed were to make that decision, they might be seeing things on the economic horizon that we are not. And that could induce some lack of confidence. And that's exactly what the market doesn't need at this point because there's so much uncertainty out there already. So it is a bit of a knife edge, but I think you've placed it really well in the sense that Wall Street is looking for support from the Fed. It's going to get it. It just may take a little bit longer.
What else are you watching, Martin, or should anybody be watching in terms of whether the Fed is able to achieve the so-called soft landing? Outside of inflation, what else might be worth keeping an eye on?
Well, Fed Chairman Jerome Powell made a keynote address at the annual retreat that they have in Jackson Hole, Wyoming. Sounds like quite a nice gathering, I must say. And they do it every year, and it's a chance for them to be a little bit wonkish in terms of policy. But his keynote address is something we all pay very much attention to. And he talked about the fact that the Fed's twin mandate, one of them is about price stability, but the other is about full employment, is coming into better balance. So the Fed is looking at the job market with a lot more clarity than maybe it did in the past. And as a result, Wall Street is very much focused on job market activity, particularly things like weekly unemployment claims, sentiment indicators from the Federation for Independent Businesses, and many others. If we see a slowdown in the job market, and there was evidence of that in the August numbers, then the Fed will be minded to move perhaps a bit more quickly, because not only will that mean slower inflation going forward, unfortunately, it could mean a cooling broader economy into the autumn months. But John, it has to be said, the economy is holding up incredibly well. The last assessment from the Atlanta Fed said the economy is ticking over at a 2.5% clip. That is really firm growth heading into the autumn, much higher than people would have imagined, and nowhere near recessionary territory at this point.